Welcome to the Dealmaker Zone. My name's Steve Son and I'm your host. Every episode, we interview the leaders in real estate and technology, and today we're very honored to have the co-founder and CEO of Sharestates, Shayanfekr. It's one of the leading crowdfunding platforms in New York City. Before we get into our interview, we want to thank our gracious host, Prana Restaurant, located on 20th and Madison Avenue in New York City. Welcome to the show, Al.
Thank you for having me.
So tell us a little bit about your background and how you got into crowdfunding.
Sure. So my background's actually in legal. I joined up with my partners back in 2012 for their existing business at the time, which was a title insurance company. And my two co-founders actually got started in the real estate world about 15 years ago as principal investors and developers themselves. And over the last decade or so, 10, 11 years ago, they started their own title insurance platform. And over the last decade or so, they really branded that entity as a real estate solution service. So what that meant was offering more than just title and escrow services, but also solving problems for their clients and networking for them and connecting them to one another. So sometimes what you would see happen is they'd have a client who sold an asset and had some capital to place. Other times they'd have a client who's looking for financing, and they would connect these guys without really monetizing it. And what it did for them is it was really more of a business development sort of thing. So it allowed them to build their network. It gave them a loyal client base that enabled them to grow Atlantis, which is a title company, to what's now a 34-state operation. And when I came on board with them in 2012, we were looking at, okay, what's the next step for us? How do we grow this organization even more? And that's when crowdfunding and marketplace lending really started to take off. We started to hear more about companies like Lending Club and Prosper. And I personally fell in love with it. So my background being in legal, I went out and I did all the regulatory and compliance work, had a few dozen interactions and conversations with the Securities and Exchange Commission and the New York Attorney General's office. We got all the compliance and regulatory work out of the way, and we started building our software, which led to our beta launch in July of 2014, and then our official launch in February of this year.
Got it. So when you actually started, so you said June of 2014? July of 2014. At the time, there were probably maybe a dozen or so real estate crowdfunding platforms, right? So fast forward today, you easily have a couple of hundred crowdfunding platforms. It seems like every other week there's a new platform, right? So walk me through where you see the industry. Do you think it's going to go the route of, let's say, financial institutions where you have hundreds of thousands of banks that provide lending services to people? Or do you think it will be like the automobile industry, where back in the 20s, you had thousands of competitors, but eventually consolidated around like top 3 or 4? And in each scenario, where do you think Sharestates would fit?
Sure. So I definitely think it's going to be the consolidation route, primarily because what we've learned throughout this whole process is that the biggest obstacle for most platforms out there is having access to deal flow. I didn't mention this earlier, but one of the reasons we decided to get into this space is because having the connections and the network that my co-founders have, deal flow is actually our secret sauce. We have access to a ton of quality deal flow. And it was a business model that they were already doing the old-fashioned way through syndication. So this for us was really just a matter of building the technology, building the platform, and taking a business that we were already doing and making it better, making it more efficient, making it faster, making it more transparent, and also opening it up to a broader audience. So I definitely think there's going to be consolidation in the future. I think the biggest obstacle for people is going to be accessing deal flow. The companies that have access to deal flow are probably going to do well for themselves. I want to say there's probably a dozen or so companies right now that have traction, our platform being one of them. And Lend Academy actually just released an article that was that basically disclosed what the average monthly originations for the top platforms were.
And where did you guys
fit? We actually came up second on the list, only behind Lending Home. But Lending Home is a completely different business model. They're doing residential owner-occupied mortgages, whereas we're doing mortgages on investment properties.
Okay, you've made a lot of excellent points in there. So walk me through your specific segments. Like, who are you targeting in terms of the sponsors, the people who upload the deals who come to you for investing, and then the people who actually the crowd. So walk me through your segment.
So our borrowers are typically real estate speculators, seasoned real estate speculators and developers that have been in the industry anywhere from 3 or 4 years to, in some cases, 15, 20 years.
Got it. And your platform is New York City centric, right? Or are you elsewhere as well?
We're primarily in the Northeast right now, so we're heaviest in New York City, followed by New Jersey, and then a little bit in Pennsylvania and Connecticut.
Mm-hmm. And we're looking to expand to Florida and Texas in the near future.
Got it. And what's the deal size?
Average deal size
for us runs anywhere from $250,000 up to about 1.5, 1.6 million. And we have some outliers in the $2, $3, $4, and $5 million ranges.
Got it. Some platforms are debt-centric, some are equity-centric. Can you walk us through where you are and where you started?
Yeah, so we offer both types of opportunities on the platform, but we're very heavy on the debt side. So probably about 97, 98% of what we offer on the platform is a debt product. We've done about 4 equity projects to date, but we reserve those equity projects specifically for projects with sex appeal, like curb appeal is a better way to put it, I guess.
Uh-huh.
So as an example, we did a ground-up luxury condominium development project actually right here in the East Village.
So you do ground-up development?
We've done ground-up.
Because I know some crowdfunding platforms specifically don't, just because of the risk associated with the ground-up, but you guys are comfortable doing the ground-up.
My mindset has always been that if you're going to take the risk of being in an equity position, you're usually doing it to shoot for the higher returns, right? If you're investing in a cash flowing property in an equity position, odds are you're taking in cash on cash annualized returns between 8 and 10%. In most cases, there are obviously exceptions to that rule. You can get the same cash on cash returns in a debt product and be in a much safer position with the opportunity to foreclose on a property if something were to go wrong. So my mindset is if you're going to be in an equity position, if you're going to be in that tranche of the capital stack,
you're typically going to be shooting for the 20, 30, 40% annualized return. And you're not going to get that unless you're talking about some sort of project that either has heavy renovations or rehab involved in it, or some sort of an extension where you're building up or extending the foundation and building back, or ground-up construction.
So that's if we're going to do an equity project, we're typically looking at ground-up construction. And those have historically for us netted 30 to 40% annualized returns.
Have you had any exits so far on the platform? So people have invested and then...
Yeah, we've funded about 70 projects to date. We've got about, as of the end of August, about 50 million originated on the platform. We're on track to close about 15 million this month alone.
And what do you think it's going to be by the end of the year?
By the end of the year, we should be around $100 million in originations.
So I read somewhere that you guys were going to be like the E-Trade of real estate. Now, E-Trade's about stock investing, right? So the difference between stock and real estate, usually it's the liquidity component to it, right? So educate our audience, because some of our audience members know a lot about the industry, some may not know as much. So I come onto the platform, I'm an accredited investor, right? So I make between 200 and 250. I have a net worth of $1 million, excluding my personal real estate, right? That's kind of what it has to be in terms of being an accredited investor, correct?
Yeah, so you have to have a net worth of $1 million or more, excluding your primary residence. And or the alternative is that you make at least $200,000 a year this year and the preceding 2 years, or $300,000 if you're married.
Got it. So I come onto the platform, I see this property I'm interested in investing, so let's say I put $10,000 in. What happens then after I put my $10,000?
So the E-Trade of real estate quote was actually something that Business Insider put in there for us.
Okay. That came about because our first product offering on the platform was actually what's called a Regulation A project, which means that project actually was open to non-accredited investors as well. And we went through what's called a qualification process with the Securities and Exchange Commission and the New York Attorney General's office, which is kind of like a bare bones IPO in a sense, which then allowed us to market to non-accredited investors. So we were, the immediate target was everybody. Since then, we've realized that the more scalable business model is to do the accredited route, just because the qualification process with the SEC takes time. We did it in 11 weeks, but average qualification times are anywhere from 9 to 18 months, which just doesn't work for what we're trying to do.
So I invest, I put the $10,000, like what's the time frame? When can I get the money out if I change my mind? Like next week, what's the process? Because with stocks, I can buy Apple and then I change my mind and sell the stock. So what's the process?
So there's 2 components to this. our loans on the platform are typically short-term loans. They carry on average a 12-month term with an option to extend for 6 months. The loans are typically being repaid in between 6 and 9 months. So what we typically tell our investors to do is to obviously diversify, spread your capital into multiple deals
on your platform.
On the platform, and that way you have what we call rolling liquidity, which basically just means that if you take a few $100,000 and you put $10,000 into each deal, odds are those are all going to be paid off at different points in time. So as that gets paid off, you can then decide if you need to pull the cash back out or you can put it into another deal. An alternative to that is to build a secondary market that allows you to actually sell your position in a project before the loan comes full term.
So how does that work, the secondary market?
That there's a lot of compliance and regulatory issues involved with it. It's definitely something that we want to provide, and it's something that we're working on.
So you're not doing it now, but it's in terms of the trajectory of the company, it's something you guys are looking for to increase the liquidity.
Yeah, in the next year or so, hopefully we should be rolling that out.
And what percentage of your investors are repeat? So from when I put the 100,000 and I spread out and I got 50K back, what percentage of the time do I reinvest the capital?
I don't have the exact figure offhand, but I want to say it's definitely over 90%. Anybody who's invested with us at least once, unless it's one of our more recent newer investors, anybody who's invested at least once with us has come back and invested in another deal.
That's a pretty good track record if it's 90%, because I saw an interview from the founder of Realty Mogul. She mentioned that their rate was about 70%. So if you're at 90, then that's pretty good.
Yeah.
So
we also have I'm sorry to cut you off. We also have a lower investment minimum. So I think Realty Mogul and some of the other platforms, if not most of them, start at 5,000, whereas we start at 1,000. So I think it's easier for people to come in and get their feet wet and invest in a couple of deals, receive some distributions on those deals, and then they come back and invest more. Yeah.
That does make a lot of sense. So I actually tried out the platform today. I like the product. I have a question about the rating system, right? So it goes to A through D. And when I was reading, it mentioned that it's not necessarily tied to the risk, but it ties to the return. So if it's like A, then maybe it's a lower return versus the D- and D+. I didn't see as many Ds listed on the platform. It's mostly A and B. Can you walk me through like the assessment and how you kind of determine the rating?
Sure. So if you go to our How It Works page, you'll actually see what we call our risk matrix, which looks at, it's 32 different data points, but it's 9 key categories. So we're looking at the loan-to-value ratio of the property, the market that the property is located in, so whether it's a core urban market or a secondary market or a rural or emerging market. We'll look at the occupancy levels of the property. We'll look at the development phase of the property. Are we talking about ground-up construction, value add, or a rent-stabilized property? From there, we'll delve into the sponsor's experience. How many millions of dollars worth of transactions has he or she completed? How many actual projects has he or she completed? Have they worked in this particular market before? Have they dealt with this particular property type before? Have they done this development phase before? So, we've had people come to us that have done primarily rehab projects, and they're looking to get started on their first round of construction project, and it doesn't meet our criteria, right? We look for our borrowers and our sponsors to have experience in every single facet of the transaction. So market, development phase, property type, etc. And then, of course, we're going to look at the creditworthiness of the borrower. So, what is their credit score? Do they have any delinquencies on their record? And we also take for full personal guarantees on all of our loans.
So when you look at all those factors, that's how you determine how to rate. So
what that'll do is each one of those 9 categories has different buckets. And we rate those buckets on a scale of -2 to 5. So each sponsor will fall into a bucket in one of those categories. We tally those points up. Our software does it, but those points are tallied up. And then it correlates to a risk rate. So based on the score they get, there's a risk adjustment for the annual interest rate that we would need to receive for that project, and a grade assigned to the deal. We do have, I believe it's a 2% margin for negotiation, because there are just, in the environment that we're in, sometimes you just need to be able to beat somebody's pricing. So there are instances where you're going to see maybe an A- and a B+ borrower having the same interest rate, right? But it's just a matter of negotiation. So we're always trying to maximize that. But
Got it. So I totally understand what you're saying. My question though is like for the C and the D, as an investor, how should I interpret those on your platform?
So in order to get to a C or D range, you would basically be needing to be in that upper or lower end of the bucket, depending on how you want to look at it. Typically, you're going to be looking, a C project or a D project is typically going to be a ground up project, which inherently means you're going to have low occupancy, and you're also going to have.
There's to ground up development, right?
Yeah.
Because you mentioned the occupancy. By the time the project's complete, you have an idea where the market might be. So
exactly.
I get that. So from a sponsor standpoint, I understand my project might be C or D because it's ground up. The reason I'm asking you the question is because I just want to see, like, from the perspective of a sponsor, like, how do they view if their deal is now rated A versus an A?
You know, I haven't had anybody ask me that.
Okay.
So it hasn't been an issue yet, but I mean, the answer would just be that, listen, it's a measure of risk. If you're talking about a ground up project with, obviously there's no cash flow, very low occupancy, or no occupancy because it's ground up. It's just, you're going to be at that end of the spectrum because multiple buckets or multiple categories
are going to have a low score because of that.
Got it. So I'm going to ask you one more question about your platform, then I'll ask you some general questions about the industry. So on the platform, you have deals that are funded, right? You have deals that are cash flowing, I believe, and then you have deals that are raising capital. So what's the breakdown versus a funded and one that's cash flowing? What's the difference between the two?
Sure. So the projects that are marked funded on our platform are projects that have recently funded in the last month or so. And that means that the first payment from the borrower, it hasn't been due yet. It hasn't been distributed to investors. So mortgages are paid in arrears. So today is September 25th. If the loan closes today, what we do is we collect per diem interest from today's date through the end of the month. And then the next payment from that borrower actually isn't due until November 1st. Because that payment November 1st is actually paying for the month of October.
Got it.
So what will happen is a project status on our platform will be funded for about 30 days or so until we get to that next payment. Once they make their first payment and we actually make the distribution out to our investors, the status is changed from just funded to cash flow.
Cash flowing. Got it.
Which just means that our investors are now actually receiving distributions on the project.
Got it. So from a macro standpoint, a lot of your competitors and yourself, you pre-fund deals, right? So I know you guys raised, I think, $30 million. Is that correct?
That was a debt capital commitment from an institution. So there's a distinction there, which is that the capital that we raised was not them buying into the equity of our company. We're still wholly owned.
It was to fund deals.
It was to fund deals, and they've actually since then increased that to $50 million, and that commitment's being increased again.
So it's like a line of credit?
Not really. They're actually
Investing the same way that you would invest in the platform. So
Got it.
you actually, what some platforms do, and this is like what Lending Club does, is, and it's probably because of the size of their loans are only $35,000, but they basically
have
have
an institutional platform and then they have their retail platform. And I think some of the crowdfunding companies do this too, where they almost cherry pick deals to feed to the institutions, and then sometimes the individual investors get stuck with the scraps, for lack of better words. We don't do that. What we do is we actually allow our individual accredited investors and our institutions to invest in the exact same deal. So we don't sell a whole loan to an institution and then crowdfund some, right?
Anytime you see a project on our platform, so if you go on there now and you see there's 8 or 9 active deals that are funding, those deals actually have an anchor institutional investor in it. So it'll actually go onto our platform with, let's say, 70, 60, 80% funding already in place, and then our individual investors can invest in the exact same deal with them.
That does make a lot of sense. So let's talk about real estate broadly and then crowdfunding. So in our industry, we go through cycles. We're in an election year, so we have no idea who's going to be our next president, what the Congress is going to look like. Interest rates have been historically low, so chances are they're going to rise. Let's just assume, worst case scenario, we go into a downturn, there's somewhat of a recession. What usually happens is properties don't trade as much, right? Lending requirements kind of tighten up, and some investors might want their capital out, right? So in that environment, how does that impact real estate crowdfunding? Because our space hasn't been through a cycle yet, because real estate crowdfunding is very new.
Right.
How do you think that impacts the industry, and how do you think Sharestates will adapt to it versus the competitors?
So I think you have a two-pronged question here, which is one, what if our investors want money out?
Yes. And two, what's going to happen to our products?
In general, because the product itself has not been through a down cycle, right? And you haven't yet had a chance to see some crowdfunding platforms that say lose money for investors. So how would investors react? Because it's new to them.
Of course. So I can tell you, we personally haven't had any defaults, delinquencies, or losses of any kind. What I can tell you from there is that from 2001 to 2013, I mentioned earlier that my co-founders were syndicating these deals for their clients the old-fashioned way.
It wasn't their core business practice, so the number is not enormous, but
they syndicated roughly $30 million across 40 different projects from 2001 to 2013 through the financial crisis. In that time, they didn't have any defaults or losses, and we basically took the same underwriting criteria that they were using there. Mm-hmm. We applied it to Sharestates, and we made it even more stringent. So as far as something happening to the product in our platform, I think it's ultimately going to come down to the platform's ability to underwrite the deal flow, make sure that they're not over leveraging themselves, make sure that the sponsor, the borrower always has skin in the game, make sure that if you are going to be financing, let's say a rehab or a construction portion to a project, that you're requiring the sponsor or the
borrower to put their capital in first. Make sure that they're heavily invested. And from there, don't finance their closing costs.
Because I know some platforms right now are financing closing costs. That's points, they're taking interest reserves, they're not checking financials. I mean, what happens when the project runs over? Are they going to be able to continue making payments? It really is, it's going to come down to underwriting and making sure that you're being conservative. As far as the investors being able to get their money out, this ultimately goes back to the liquidity question, which is we can't do anything to force somebody to repay early, right? If you're investing as an investor, you need to invest knowing that you're going to potentially be in that deal for the full term, which in most cases is 12 months. And there's always a potential, no matter who you are or what platform you are, there's always a potential that somebody could default. And if you have to go through that foreclosure process, depending on where the property is located in, which state the property is located in, that foreclosure process could run over the 12-month period. So it's you just have to be prepared as an investor. Diversify, make sure that you don't have all your eggs in one basket, you're not in one single loan, and make sure you're not counting on that capital for emergency reasons. Always have a nest egg somewhere else.
Definitely. I mean, so if I understand you correctly, basically one of the key things is education. So investors have to understand that when they're investing, it's still real estate, so there's a due diligence process there, but also the liquidity component. If you're investing for 12 months, you may not have access to the capital. You can't have access to the capital prior to that. The reason I was asking the question is because the real estate industry is an industry that's really slow to adapt and change.
Right.
And crowdfunding it's a new concept, right? So although you have traction, a lot of companies have traction, it's still like a small amount of transactions that are actually done through the product. So technically you still have a lot of potential and room to grow.
Of course.
So we're almost done with our time. Do you have anything you want to share with us? What's next for the company?
We have some really cool items that we're developing on the tech side. It's really, at the end of the day, all about automation. And the goal is, one of the unique things that we have access to in this space, again, this goes back to my co-founders, love those guys. They are actually one of 12 underwriting licenses in the entire state, title insurance underwriting licenses. And if we're ever going to take this industry and make it fully automated and fully online, that means that at some point you're going to have to start getting into things like virtual closings, which just, if they haven't been done yet, like you said, real estate's really slow to move. Different states are going to have to approve things like remote electronic notaries before that can become a reality. But the biggest player in deciding whether or not, like an e-closing, for example, or virtual closing is going to ever happen is going to be the title insurance provider, because without that, you can't have a closing. And odds are most title insurance companies, underwriters, are not going to allow for an e-closing or virtual closing. So I think we actually have a really cool hand that we have yet to play, and that's ultimately going to come down to activating that underwriter's license. And this probably won't be in the near future. But it'll be really cool if we can actually activate that, and as an underwriter, enable our platform Sharestates to actually have virtual closings. So as a borrower, your entire experience will be online.
Could be online. That sounds pretty cool.
Yeah, you won't have to actually physically go to a closing table. So.
Yeah, that definitely sounds cool. Save a lot of time, save money probably.
Yeah, definitely.
So this is our episode this week. In conclusion, I think we're still in the earlier stages of real estate crowdfunding. It's very exciting. A lot of the key players have done a tremendous amount in the space, but we still have a long ways to go. This is our episode, and thank you.
Thank you.
It's like this, tired of all the nonsense. Like I dropped out of college, got me some common sense. I know you're scared of the God made rule. Forget the theater, coming to a block near you. Those that knew defeat, I'm a wreck-it. Flow grammar, rose the groove from concrete, check it. No amber, peep to bring it back. I'm quick to beat up on the track. No need to teach me how to Dougie, but I can teach you how to rap.